Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, it's episode number 73, and we cover variable annuities. Those of you who know me know my take on annuities and variable annuities in particular might know that I'm not a huge fan of the product in general, but that said, there are some circumstances where they can make a lot of sense. And today on the podcast, I cover what these products are, why I tend not to be a big fan of them, but the few circumstances where they can make a lot of sense from a tax and financial perspective. So we go into detail on annuities today. I hope you enjoy it. Okay, variable annuities. I was looking through the list of past episodes on the podcast over the week. So this week is number 73. And, you kind of get in the habit of doing these recordings every week, and then the numbers just start to pile up. And I can't believe that we've done 73 episodes of the show. I feel like I'm just kind of getting my wings and feet under me, and I'm still kind of figuring out what I'm doing, as you all can probably tell from the quality of these episodes. But I was surprised when reviewing the list of topics that we've covered on the show that we haven't covered annuities in more detail yet. Because annuities are they are an insurance product that are pretty, what's the right word? Not quite popular, but they're very common in the industry. They're often used to solve for a bunch of different retirement income issues that people might have. And over the years, I have grown to not be very fond of them in almost all circumstances because in general, they end up being a really good product for insurance companies, a really good product for representatives who sell them, not a very good product for consumers and people who purchase them. And so in this week on the podcast, I just wanted to cover this in more detail. And, to be totally clear, like the investment stuff that we talked about on the podcast, like the economy and what's going to happen in the future and all that, it doesn't pay to be closed-minded on these things. And so I think a lot of advisors, I know a lot of advisors that I've run into across the industry, particularly in the fee-only space, tend to get really closed-minded to where they don't even want to consider a variable annuity or another insurance type product as a potential solution for their clients, because you kind of fall into the trap at some point of thinking that all insurance is evil. And on the other side of the coin, you have insurance-based advisors who think that the only possible solution is an insurance-based solution. And that might not necessarily be because they're being closed-minded, but because that's how they're compensated. They're compensated to sell the product, not to come up with different alternatives. So there are a lot of different advisors across the industry. Everybody comes from a slightly different background and perspective. But one really common issue that I run into is when it comes to the solution of problems. When a professional has a client come in and they say, "Hey, I'm getting ready to retire. I'm trying to figure out how to draw income from my savings, from my portfolio, wherever their nest egg might be held." Advisors just tend to fall into the same recurring pattern over and over and over again, even as the industry and the landscape changes over time. And so just like in investing, where you're trying to use the relevant data available to you in a completely objective way and draw a logical conclusion from that will lead you to the best outcome. When you're working with clients with various problems, you want to take that same approach to the solution that you use to solve that problem. And historically, I've been kind of sour on variable annuities for reasons that I'll go into here in a couple of minutes. But the landscape is changing, and there are circumstances where this product can work for a lot of different people. So today on the podcast, I just wanted to cover what variable annuities are in the first place, why they're such a controversial product for a lot of people across the industry, why they've developed a bad name, why people like me have not been particularly fond of them for years and years and years, and how the landscape is changing and the circumstances in which they can be a really good option. So let's take this from the top. An annuity product is basically a product where you fork over money to an insurance company and they're going to give you a promise for something in return. It's an insurance product. It's not an investment product at its core, which means that the circumstances and details surrounding when the insurance company might pay you back are just all over the place. And they're governed by insurance regulation, which is a little bit different state to state. Some annuity products are such that you fork over money to an insurance company and they give you a consistent stream of income, like the exact same dollar amount in the form of a check every month for a certain period of time. And that could be for 5 years, 10 years, 20 years, the rest of your life, the rest of you and your spouse's combined lives. There are a lot of different ways that you set it up. And so in that kind of really basic annuity, let's use a single premium immediate annuity, for example, which, and the acronym there is SPIA, SPIA. Sorry for using acronyms. But the idea is, if you're trying to create a consistent income stream, you have $100,000 saved up, you're trying to turn that $100,000 into income to pay your bills for the rest of your life. You could invest it in stocks and bonds and then withdraw from that account over time to pay your expenses and feed your bank account. Or you could fork it over to the insurance company and say, hey, here's my cash. I want you to promise me to give me a check every month for the rest of my life, and turn that into like a personal pension, really is what it is. So what the insurance company does in this kind of arrangement with the single premium immediate annuity, single premium means you pay the insurance company one time. Immediate means that you collect on that. You start collecting checks immediately. And so what the insurance company does is they turn around and take that $100,000 and they match the liability they have to you in the form of that monthly check with a number of bond investments. And so these single premium immediate annuities, if you're trying to create an income stream through one of these products, the amount, the size of the check that you're going to get every single month depends on the market level of interest rates at the time. Because the insurance company isn't going to pay you an equivalent of 8% per year on your $100,000. And they have a massive team of actuaries in the back room, which I kind of equate to a bunch of monkeys on typewriters. Sorry if there are any actuaries out there listening to this. Running the numbers and trying to figure out how long you are likely to live and what an appropriate monthly check might be. So with interest rates so low right now, you're not going to get a whole lot of money in return every single month for the rest of your life in one of these products, because it's based on the market level of interest rates. Now, that doesn't mean that this is a terrible product or anything like that. It can work for a lot of people who have no capacity to take risk whatsoever and really need a consistent income stream in retirement or maybe in another phase of their life. So that's the most basic form of an annuity. You fork over money to an insurance company, you buy this policy, they promise you something in return. The most basic way is to collect a monthly check for the rest of your life from that point on. But there are a lot of different ways that these products are set up. Another way to set it up is a single premium deferred annuity, where you fork over money to the insurance company one time. That's what single premium means. But rather than collecting a monthly check starting today, you allow your assets, the money that you give to the insurance company, to grow within the policy, and then you turn on that income stream sometime in the future. So in this arrangement, a single premium deferred annuity, the growth that you get in the policy is still dependent on interest rates. It's kind of like putting money in the bank and right now and earning interest on it. You're not going to get very much growth in a product like that. The benefit is that that growth is tax deferred. So if you put $100,000 into one of these policies and then you let it grow for like 10 years, and 10 years down the road you have $105,000 because, again, interest rates are low, you're not going to get very much in return. That $5,000 is tax deferred. And when you trigger the income stream, when you start collecting checks 10 years down the road, that check has a portion that's taxable to you and a portion that's not taxable at all. And the ratio there depends on the value at the time of annuitization, so $105,000, divided by the $100,000 that you put in. And that that growth portion is what's taxable. The non-growth principal is not taxable. It's considered return of basis. So you get a check every month for the rest of your life, whether you decide to turn that income stream on today or at some point in the future. But again, everything is based on the market level of interest because that's what the insurance company is using to match your the liability they have with you, which is that future stream of checks. They're matching that with an asset with a similar risk profile, which is a bond investment, because they have consistent outgoing interest they're paying you in the form of the check. They have to offset that with and match it with a similar asset on their balance sheet. So that's the most simple form of annuity. Variable annuities that I wanted to cover today are a little bit different. So you fork over money to an insurance company in a variable annuity, and then at some point in the future down the road, you're going to turn on that same income stream and pull money out of the policy. And there are a number of ways that you can do that. There are all sorts of different structures and setups that insurance companies will create here. But the idea is that in between those two periods, after you give money to the insurance company and put money into one of these policies, you have a menu of what are called sub-accounts to invest in. And these sub-accounts are just like mutual funds. And so if you have like a Vanguard mutual fund, that same portfolio that Vanguard manages is going to be offered in some variable annuity out there. It's just called a sub-account. The sub-account is just a different wrapper for the same portfolio. So if you forked over $100,000 to an insurance company, you get to choose the investments that those funds are put into. They're called sub-accounts. You have a limited menu. Some variable annuities only have 15 to 25 different options. Others have like 100 different options you can choose from. There are all sorts of different policies. But you invest in these options and the balances grow over time. And so compared to this single premium deferred annuity that I described earlier, in the single premium deferred annuity, your rate of growth is going to be based on interest rates at the time, which, again, very, very low right now. When you invest in stocks and bonds and whatever these sub-accounts invest in that are offered in the product, the idea is that they're going to grow faster than they would in another type of product. And since that growth is tax deferred, the selling point here is that it's kind of like putting money into a 401k or other type of retirement plan. And there is a fact pattern here where these kinds of policies and products make a lot of sense, particularly with really, really high income people who max out all the tax advantage retirement savings vehicles they have available to them. If there's a low cost variable annuity that's available and you have way, way more cash than you know what to do with, well, sometimes it can make sense to put that into one of these products because the growth from that point on within the product will be tax deferred, which can be really, really convenient for some people. The problem is that variable annuities exist because insurance companies in general like to create insurance-based solutions that are like a one-stop shop to a bunch of different problems all at once. And the problem that annuities solve in general is they help people create a consistent stream of income in retirement. So you might say, well, you're a saver for the bulk of your life. I want to turn my savings into consistent income. Single premium immediate annuity is one way to do that. But another problem people might run into is, I'm really limited on the amount of tax deferred saving I can do in the first place. What if, how can I save more on a tax deferred basis now, or at least shield my future growth from taxation and have that income feature later on? And one solution to that problem might be to use a couple different types of investment accounts and then convert it into a personalized pension through the annuity later. But what insurance companies have done over the years is say, well, hey, I got a better idea. Why don't we just create this product where you can invest inside the annuity and we can kill two birds with one stone? And so it's a one-stop solution for somebody who's looking for tax-deferred growth and that future income stream after they stop working. You don't have to, there are not two legs to that transaction. There are only one through this, fancy shiny object. So the insurance industry is notorious for doing this, just cobbling together. And I'm kind of casting a negative light on this as I'm, describing it. This is the essence of our capitalistic society where, people have a problem, somebody comes up with a product or service or some combination of the two to solve that problem in return for, a fee or a price. And that's exactly what the insurance company is doing. So I don't mean to be that terribly negative on this. The problem is that the more features that these products tend to have, the greater the cost. And I don't mean like a little bit greater cost. There is a massive amount of added cost historically to these products, the more features that are included. So over the years, I have reviewed a lot of these policies, and a lot of them over the years have just all these different layers. So when you put money into a policy, you might have like an administrative fee. I don't know, some of them are like $25 a year, which is almost free, very, very low. But then you might have a mortality and expense charge, which is the insurance company's way of compensating themselves for the risk that you die early and they have to pay a death benefit out to your beneficiaries, or perhaps on the other side of the coin, the risk that you annuitize the policy, agree to collect a monthly check for the rest of your life, and then you turn around and live to like 105, so they're paying you forever. Those kinds of events are risks to the insurance company, and so they impose a charge through what's called a mortality fee to compensate themselves for that risk. On top of that, there are fees surrounding the individual sub-accounts within the policy. Some of them are low cost. If you can find policies that offer that Vanguard option that I described, it's going to be very low cost. Some of them are your more traditional active mutual fund and asset managers that charge a lot more than that. And so over the years, when I've evaluated these policies, that when people have come into the office and asked about them, it was really, really common for the all-in cost on an annual basis to exceed like 3% per year. And that's just a huge cost in exchange for the benefits you get out of one of these policies. And yeah, the tax deferral is nice, but there are a lot of other ways to do it too. And on top of that, because these things are so expensive, they tend to be really, really profitable for the insurance company. And the more features that the insurance company jams into one of these products, the more ability they have to spread the risk that the deal goes south for them across a bunch of different policyholders, and the more profitable it is for the company because they can just charge more the more features that they have. And I'm kind of butchering the way that the math works from the insurance company's perspective. But the idea is that they're really, really profitable to the insurance company. And because of that, they want to push these products very aggressively. And so historically, and I keep using the words historically because the environment is starting to change a little bit now, and I'll get to why that is. So historically, advisors who sold these products would receive a commission for doing so. And the commissions that you receive for the upfront sale compared to the trails and compensation that you get after the fact for servicing existing policies were just astronomically different. And even recently, a lot of these policies would pay upwards of like 8 or 9% commission on day one to the selling agent who sold them. So if you had, years ago, you had a lot of people out there who were kind of masquerading around as financial advisors, selling these things, and inviting the unsuspecting public to steak or chicken dinners to in exchange for hearing their spiel about how great these products were. And they would just pay out the ears to host these events because at the end of the day, if they could convince one person or one family in that group of 30 or 50 people who are there just to show up and eat the free dinner in exchange for listening to the spiel, then that would easily pay for the dinner and the representative's mortgage and staff and all the above. I mean, and using the $100,000 example, all you have to do is sell one person a $100,000 policy, and what you get in return is a $9,000 commission for that. It's just a huge amount of money. So, and the reason that the insurance companies are able to pay that much, again, is because these products were so profitable for the insurance company. And, anytime you have a fat profit margin for the insurance company that allows them to pay a seller of the product such a huge commission, this is a zero-sum game at the end of the day. I mean, it's not like they're creating an additional $9,000 of value for the clients and people they're selling the product to. The fact that they're able to pay such a large commission means that it's good for them and not so good for people buying them. So this has been a big issue over the years. Now, I say that it's changing now. And this is true. A number of insurance companies have started to offer what are called fee-only variable annuities that are offered without a commission, which I think is a good option to have. It's not by default the best product, but it's a step in the right direction. And some of these layers of fees that I described earlier, where in some they used to add up to more than like 3% per year, which is really, really high, they are being adjusted downward, and different flavors of these products are starting to emerge to where, and if you use the analogy of the investment markets, years ago you had a bunch of mutual funds who were doing all these active strategies, and at the end of the day, they weren't really earning their fee because you were just as good or better investing in a low-cost index fund after the expenses. Annuities are starting to go through that same cycle where the lower cost investment options are starting to be offered. The products are starting to be offered with fewer features, and the layers of fees themselves are less expensive. And so some of these products are starting to make sense. One layer fee that I forgot to mention that is relevant here too is what's called a surrender charge. And so years ago, when you have a really profitable policy for an insurance company, oftentimes it would come with a really long surrender charge, where if you decide to surrender the policy inside of like 5 or 7 years after purchasing it, where you just call the insurance company and say, hey, I want my money back, I want out of this policy, they'll ding you a hefty percentage of the face value of the policy. And I can't remember off the top of my head how large these surrender charges used to be, but they were substantial. And the idea was that if you're the insurance company and even though these products are profitable, if the buyer hangs on to the policy for a long period of time, if they turn around and back out, like within the first year or two, it's not nearly as profitable, which means that the 9% that you paid to the selling agent might cause you to be underwater on the deal. So they have surrender charges because they're paying such high commissions to these sellers. Well, the surrender charge is one of the things that is starting to go away. So there are now fee-only options where you can have an insurance representative offer you a variable annuity where they don't make any kind of commission at all. There's some kind of fee arrangement somehow, but there is no commission for the sale of the product on day one, and the total amount of fees for being in the policy are more reasonable. So that doesn't make this a real exciting option in my mind for most people, at least most people that we work with at our financial planning firm. But I will say that there are a couple different circumstances where it really makes a heck of a lot of sense to entertain one of these products, again, with low fees and no surrender charges. So that's really what I wanted to cover in this episode is, what are these things? How is the landscape changing? Why have they not been good in the past? Why are they becoming good now? And when might they be a reasonable option? So the main circumstances where they're a good option is, number one, if you have an existing insurance product with a cash balance that you don't necessarily want to get rid of for tax reasons. And one example of this is we've had a number of clients in the last couple of years with whole life insurance policies that they thought they needed, but turns out it wasn't really a good fit for them. And now they're not really sure what to do with them. Well, in the insurance world, you can do what's called a 1035 exchange. And real estate investors out there might think of 1031 exchange when I say that term. The deal with a 1031 exchange is if you own a rental property and there's a gain that you have in that property, well, if you sold the property and used the cash to buy another one, so you just wanted to swap properties and maybe get something bigger because you have a bunch of equity in the first property, well, you might be disincentivized from doing that because you pay tax on the gains of the sale on property number one. Well, there's this section in the tax code, section 1031, that allows you to sell property number one, buy property number two within 45 days, and defer all of that gain and not pay any tax on it. And the section of the tax code, it's called a section 1031 tax-free exchange. Well, the similar philosophy, a similar strategy is held within section 1035 of the tax code. And so if you're someone who has like a whole life insurance policy that you've had for a while, maybe you have some cash balance in there you're not really sure what to do with. The deal with these whole life insurance policies is that if you decide to walk away from them and surrender the policy, and again, none of this is investment or financial or tax advice. That's what my attorneys tell me to say, of course. You should definitely evaluate how much insurance you need in the first place and come to a good decision about whether you can afford to walk away from the policy. But if it turns out that you do want to walk away from the policy, then if the cash value in this policy is greater than the total amount of premiums you've paid into the policy to keep the insurance, then that difference is taxable income to you if you surrender it. So let's say you've got a policy you've had for a little while, you've got $50,000 in the policy, you've paid premiums of $40,000 over the years to get to that cash value. Well, then that $10,000 difference is going to be taxable as income if you surrender it and take the cash out. Well, this is where a 1035 exchange might make some sense because a whole life insurance policy might not be the best fit for you. But just like a 1031 exchange with real estate, you can swap that whole life policy out for another financial or insurance product like a long-term care policy, like another type of life insurance policy, like a variable annuity, and defer that gain via Section 1035. And so, whereas a whole life policy might not be the best fit for you because of, the likelihood of low returns on that cash balance alongside the cost of the insurance premiums to maintain the death benefit, well, a variable annuity might, a low cost variable annuity might be a reasonable alternative. And by swapping into one, you can use that cash value for continued tax deferred growth and kick that income tax ramification down the road, which can be really helpful. So again, measure twice, cut once here. Number one, don't get rid of a life insurance policy you have before you're absolutely certain that you don't need it. Or if you're going to replace it with like a lower cost term policy, that term policy is already in place, in force before you abandon policy number one, because you have the chance of surrendering a policy and then not being able to replace it. But if you're all set on your life insurance needs, then that can be a nice possibility. We've worked with a lot of other clients who have other types of annuities where it's just not set up in a way that's aligned with their objectives. Maybe like single premium deferred annuities is a good example of that, where somebody's pretty close to financially sound, financially independent, or maybe already there, but they have all these assets in deferred annuities that are not growing for them. Well, you might not necessarily want to bail on the policy and take all the cash out because of the tax ramifications. Well, hey, a 1035 exchange is a pretty good option in that circumstance. Now, the other reason that variable annuities are really convenient from a tax perspective, and this is the other scenario that's really that's really has helped a lot of our clients, is if you're in that same situation and you have maybe a life insurance policy that hasn't performed very well. Well, in the previous example, you had a cash value, Friday afternoon, and I'm already slurring my speech. If your cash value is $50,000 and your total premiums into the policy is $40,000, well, you have a gain of $10,000 you're going to pay tax on if you surrender and walk away. But if the reverse is true, which to be honest is far, far more likely in any whole life policy I've ever seen, where the total amount of premiums you've paid into the policy exceed your cash value at the time. Let's say you've put $60,000 into the policy and you have $30,000 of cash value, which is far more likely in any policy that I've ever run across, these days at least. Then if you surrender the policy and walk away with the $30,000, you don't get to claim that $30,000 loss. It just kind of evaporates. But if you 1035 exchange that into another type of financial product, whereas you cannot claim a loss in a whole life policy, like I just described, you can claim a loss in a variable annuity. And by using this 1035 exchange that I described, you retain your original basis of $60,000. Now, there are some caveats here, and you absolutely want to find a product with no surrender charge because you have to hang on to the policy for 6 months before you can ditch it and claim the loss. And you don't want to claim the loss and pay this huge surrender charge. So find a policy that's not going to ding you on the way out if this is a reasonable strategy for you. But for most people, if you have a substantial loss in a permanent life insurance policy, you might not just want to walk away from it because the tax savings there are big. I mean, if you can claim that $30,000 of loss, if you're in the 24% tax bracket, just off the top of my head, that's what? It's Friday afternoon, so I'm losing it. But $6,000, something like that, $8,000 in tax savings. That's substantial. Now, there is a little bit of an argument and a gray area here surrounding whether and where you can claim that loss. Most accountants I have collaborated with and asked about this are very comfortable claiming that loss. There are some other tax professionals who might not feel that same way. So again, this is not tax advice. Claim the loss at your own peril. But if you have an accountant and you have a permanent life insurance policy you're not really sure what to do with, well, this is an area where a variable annuity might be a reasonable option, either A, to preserve cash value, avoid claiming the gain and providing tax-deferred growth, or B, not walking away from the loss and using the VA as a conduit to deduct it later on. So we got into a little bit more technicalities here than I had anticipated, but that's how I'm seeing the variable annuity landscape changing. I'm also seeing a lot of new products. These index-linked annuities are really, really popular. Not only annuities, but universal life too. IUL is a really popular product insurance people are selling, pushing these days. So we'll need to have a future episode about that because I'm not particularly hot on those products either. But that does it for today. I wish everybody a wonderful week. I think we will probably be doing a mailbag episode at sometime in the next couple months. So be sure to pop on over to growmoneybusiness.com, dump your questions you'd like me to answer on the air there, and I will collect them and answer them here in a future episode. That's it for now. Talk to you all soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.